We are now in conversation with Anand Shah. He's the head of PMS as well as AIF investments with ICICI Prudential. Anand, good morning and thank you so much for joining in. I want to take stock of the markets firstly at the moment, what you make of them with the place at that which we are right now, and how things could potentially move on from here on.
Sure, thank you. Good morning. Thanks for having me here. So I'll give you a little bit of cliched answer that, look, the expectations from market will have to be far more muted than what we have seen in last few years. Yeah. And the reason being, look, when we go back to 2020, we were also, we had quite a few inefficiencies in the market. More importantly, we had a subdued 5 years in the market. So we were starting from a low point in terms of past returns. And that generally is very good news for the future returns. Right. Now today, as we speak, we are sitting on a very hefty profits on the market. Yep. But I think more importantly, we had almost a decade of consumer-facing businesses doing very well, and manufacturing-allied businesses doing relatively soft growth, and to that extent, market was fairly skewed also. Yeah. So not only market was inexpensive, but within the market there were inefficiency where consumer-facing businesses were darlings. They were like at a very high PE multiples, price-to-book multiples. In the same time, you had this old economy / manufacturing businesses were trading relatively cheap. Yeah. Now that inefficiency is also fairly reduced. The consumer-facing business still remain more expensive than manufacturing, rightly so, but nevertheless that gap has reduced. Right. So in that sense, the inefficiency in the market over the last few years have reduced, and that means that there's so much less money to make in the market incrementally.
Yeah, but that's not what people are experiencing or seeing, Mr. Shah. They're looking at the primary market. We've had a bumper listing today, and there is that excitement growing, more retail investors coming in, and then you have what SEBI has gone and done, which is try to curb some of that froth, at least in the derivative segment. What is the impact for other investment avenues? You of course look at PMS and AIF, but more traditional avenues, equity, cash market for mutual funds. Do you think some of those flows then now come there?
No, I think that's a good news. The good news is that across the board, market participants, bearing few, are cautious. So you hear fund managers from mutual fund, you hear distributors, you hear even, when we meet investors, people are fairly cautious. People are saying, look, we want corrections. And rightly said that the regulator is also conscious of the risks that are sort of increasing by the day as the retail investors become fairly more confident on the market today than they were 4 years back. So I think that's a good news to me personally. I believe that makes it much more healthier. To be very honest, a correction would make the market much more healthier.
Which is what we're possibly seeing now. Yeah.
So I think in that sense, I'm looking at all these developments more positively than negatively. Having said that the market is not obscenely expensive, there are frothy part of the market, and that froth has to be, in a way curbed to protect the retail investors who would otherwise get sucked into those schemes. So I think all in all, I look at these steps as more positive for the markets if that leads to a market correction. I think that's the key. A market correction would be more healthy than anything else.
What does a correction look like to you is then my next question. We're sitting at about a 1% cut right now, and frankly, it's not necessarily a correction. What is your definition of a correction?
So again, you'll not like me for saying this, but in the 34 years of history that we have seen, markets used to correct very healthily, used to correct more than 20% every 13th, 14th month on an average, and market used to correct almost 10% once, twice, or maybe thrice a year. That something is missing. We are not seeing deep corrections in the market. Since 2020, we haven't seen a 20% correction, and we have seen only one 10% correction. So I think we would want to see, before committing money convincingly into the markets, maybe a 10 to 20% correction.
Wow.
That's something which would make the market that much more safer.
Anand, there are a lot of people who've been waiting for that and then looking at markets going in the opposite direction and wondering if they missed out. Is that a risk you're willing to take?
So again, that's the other thing we have been telling everybody. Don't wait for the market corrections. You need to have your asset allocation in place. So don't just sit on cash because you're convinced that the market is going to correct. Market might correct a year later, 1.5 years later also. My point being that a healthy market would generally tend to correct every now and then. It'll make it more healthier, but that doesn't mean the market corrections are imminent. Because if you see last 5 years, 4 years, while the markets have done well, corporate profits have also done very well. Right. If you see profit to GDP for Nifty 500 has moved from something like 2.6%, 2.4% to 4.8%. Nifty 500 PAT growth CAGR for last 4 years in excess of 30%. So you have tailwinds also. Yeah. More importantly, as we see, you have US, you have Europe, and you have China. 3 largest blocks of economy is cutting interest rates together at this point of time. So it's not imminent that market will correct. My point being that one needs to be cautious in the market at this point of time and focus on asset allocation. Neither side. You need not be on 100% cash, you need not be in 100% equity.
Yeah. Right. So Anand, let's assume at the moment that we do in fact see not a deep correction as 20%, maybe about a 5-6% on the benchmarks. Naturally, your broader markets will see in that case about a 15 to 20% correction. These are all assumptions. But there will always be companies out there, or rather sectors out there for now, which are on the trend of giving you growth rates of around 15 to 20%. What are those areas that one, either you'd want to remain invested in, or that you'd potentially see better prices available and then you'd want to perhaps park your funds there? What are those areas that you're keeping an eye on right now? Sure.
So before I come to this, I think one more additional data point would be good to see that when we're looking at this number sometime in the 3rd week of September when market touched new highs, there were only 95 stocks out of Nifty 500 which were within 5% of the all-time high. Right. So the market's already correcting internally. Right. We have more than 250 stocks in Nifty 500 which are more than 10% down. Some of the stocks are down more than 30%. And many of the sectors like PSU banks and others have peaked way back in June. Sure. They have not touched the new highs. So I think market is in a way also correcting while it's touching new highs internally. Coming back to, I think, what we like today in the market, we still like the manufacturing, again, more bottom up. As I said, the inefficiencies at the sector level, at the market level is not very high to say that I like this sector as a whole. Barring banking, where both private banks and PSU banks, after the near-term consolidation and underperformance to the market, looks broadly okay. But beyond banking, when we go into other sectors, will be more bottom-up. Right. We like space like manufacturing allied businesses, be it cap goods, be it power utilities, T&D, transmission. I think everywhere we are seeing bottom-up opportunities to still participate in the growth. Within consumption, we've been underweight products, but the services. So I think there's a clear trend, and that's seen globally, that as per capita income moves, the consumption pattern moves from products to services. So
you mean like a Zomato kind of or more of a premiumization kind of a situation?
One, when I'm saying services, it includes travel, restaurants, education. But also, rightly said that within the products also, the way we are consuming is changing from unorganized to organized. So our portfolios have more of this consumer services business than the products. Products, I think the penetration has happened. The larger middle class, the way is shifting, and we are sort of tracking that into our portfolios.
Right. How are you feeling about IT right now? I mean, is this the turning point? Has it come? I'm curious to know your view ahead of, we'll of course see the quarterly numbers, but the rate cut was one big factor that has come in. We'll know what happens with the US elections, but what's the view on IT?
I think IT, we've been underweight for a while now. So IT had a big bump up, both in growth and valuations during the COVID time, 2020, 2021. And since then, we've been sort of underweight, knowing or thinking the way we believe that the growth rates cannot be as good. And the multiples cannot be that high. But trust me, till then, there's not a single month, not a single day when people have not asked me about IT. So to be very honest, IT has never gone out of flavor.
So that's why the smile when I asked you, because like I was waiting for that question.
So yes, IT has been the strong businesses. They generate a lot of cash flow. Unfortunately, they don't have a lot of growth opportunities to invest that cash flow. So that cash flow is being used to pay out dividends, do a lot of buybacks. So in that sense, IT sector to me is more of a slow to medium growth industry from here on. And for that, the valuations continue to remain rich. So I haven't found valuations attractive enough for IT to plunge in, but otherwise very, very strong businesses and balance sheets.
Anand, my question is on a fundamental basis. When you construct a portfolio now, I'm assuming that you have a portfolio of about 30 stocks. The first one is that at this point in time, when markets are at where they are right now, would it be perhaps a little bit more better to have a concentrated portfolio where you actually bring down your number of stocks to 20 or 25? And again, I'm just talking about ballpark numbers. And secondly, do you think that it would be perhaps a little bit more pertinent? So for example, if you allocate about 5% to one large cap stock, would you prefer to perhaps increase that allocation from 5% to 7% towards large caps on an individual basis? Is that, would you think that would be probably a better way to go about now that markets are at extremely heady levels?
So again, I think more important question, it's not 25, 35 or 45 stocks. Yeah. There is a merit in diversification, nothing wrong with that, as long as you know those companies are worth buying.
Sure.
So to be very honest, the important question is, do you understand the business you're buying in?
Yeah.
Do you believe or trust the management that's backing that business?
Yeah.
I think we have this BMV model. We look at business, management, and valuation.
Right.
We need all the three in place. It's not either or.
Yeah.
We need strong businesses which can survive a downturn, can thrive in the good times. We need managements which are capable and the corporate governance issues are addressed.
Yeah.
And last but not the least, valuations.
Right.
So I think we are looking at all three. The number of stocks where we are more convinced today might have reduced, given that some of the stocks would have become fairly expensive.
Sure.
And to that extent, maybe we have a little more concentration, but I don't think that's the advice I would give to anybody and everybody.
No, fair enough, yes.
It needs to be well researched. Yeah. If you don't have research, then you're better off owning more companies than less.
Sure. Yeah.
The concentrated portfolio is much more riskier and needs much more research than otherwise.
Yeah. Are you over the PSU run-up? Or do you think that there's some potential there? I mean, the big theme of, say, like 4-5 months ago has sort of fizzled out for now. Do you see some interest coming back there?
I think corrections have been fairly stark. Some of them have come into buy zone. But again, as I said, even within the sectors we like, we are more bottom-up. Ditto for PSU, I think there are still companies within PSUs which might not have strong fundamentals or might be very expensive. So I can't say generally for PSUs, but we own quite a few PSUs in our portfolio. And we have been sort of incrementally looking if some of PSUs which we have sold, have they come back into a buy zone, and continuously evaluating that.
So it's a wait and watch, apply those filters carefully, especially right now. Anand Shah, I think the big takeaway that the cut is yet to come and could be 10 to 20%. We haven't seen that for a while. Do we see that or not is the big question. Thank you so much for joining us today at the NDTV Profit Studios. Pleasure to have you on.
Same here. Thanks.